All right, we are live. Let's go. This is the macro report for the stock market, for the economy, policy, right? Macro policy. Sorry, that might have been too loud. Let me repeat that. This is the macro report. I'm Jay Fielder, Jeremy Fielder, but call me Jay Fielder. And this is the end game setup for the Bears. I think this is the end game setup for the Bears. We're going to go over the macro report. The actual report will be released after this broadcast. Okay, it'll be released after this broadcast. So we'll go through a little bit of it rather quickly. Now we'll go at a good pace. If you guys have questions, let me know in the comments. We are live on both TikTok and YouTube. So just let me know. I'll check out your comments there. So, and I'm going to try to put this sound up a little bit. So there's a little bit of background noise, right? Now, the whole thesis here is we've been in this wave 2 FOMO. I really hope that isn't too loud. We've been in this wave 1 FOMO, right? Where everybody's offsides. They're positioned negative, and we had a lot of upside surprises. So we're going to go through why these upside surprises should continue, right? For the most part, I think the risk is in our favor for the bulls, right? On the crypto side, the stock market side, not every single company, but we'll get through that. So this is the end game, right? This is the end game. If this stuff starts to play out, these macro forces start to play out, and I'm seeing them start to play out. I think we keep going higher, and here's why. This is why, right? First off, we gotta understand that inflation has been the biggest issue, right, for the market. The reason why we went into a bear market wasn't because the Fed printed so much money. Okay, it wasn't because of that. It was because we didn't have the supply or the productivity to keep demand level, to keep demand tame. Therefore, inflation broke out, right? And this is globally, not just US. This is all over the world. So inflation's been the biggest, the biggest wrench in the gear for the markets, for the economy. And now that is starting to disappear, right? Inflation is starting to evaporate a lot faster than most people believed. And, hey, we'll do Q&A after this. By the way, we'll do some Q&A after I get through the report. So just throw up your questions and I'll get to them. I'll get to them eventually, right? So this is US CPI and PPI. So consumer prices versus producer prices in the blue, consumer prices in the yellow, and you got the Fed funds rate in the black, right? And basically what we're seeing here, I wonder if I can make this bigger. Oh, there we go. Yeah, that's what I want to do. I wanted to make that a little bigger. There we go. Got to mess with stuff here. And basically, you can see that CPI and PPI are basically falling like a rock, right? They're back to pre-pandemic levels. They're falling like a rock. We got CPI. Remember, CPI got up to 9.1%. Now we're at 3%, right? We're at 3%. We're going to hit the twos. And the Fed's inflation target, as they say, right? This is what they say. So this is what they say is 2%. Okay. Now, you can argue core, it's going to be at 2% headline, whatever. The market cares about consumer prices, CPI, not just core, because for most consumers, bro, gasoline prices are important, right? Energy prices are big, food prices are big, and they're both collapsing. They're both falling pretty quickly, right? Not the absolute price, but the inflation part of that. And that's what the markets are looking at, not the economy. We are speaking of how the market, how the stock market, how the crypto markets, how risk assets respond to these macro forces. And consumer prices are falling like a rock. We're at 3%. We're due to be in the twos pretty soon, right? Next month. And there's other reasons why, it's not going to fall as fast as it was. Producer prices, on the other hand, which is part of the equity market, right? People or companies who are producing services or goods, is basically at zero. We're basically almost negative. Wow. So what does that do to earnings? Just think about that. If your cost to run your business is lower, right? If those costs are coming down, well, you can definitely produce more earnings. You can retain your earnings even if revenue is falling, right? And revenue is probably falling to some degree because GDP, it has been falling, although it's been better than expected, right? And really the big thing here is in black, the Fed funds rate is at 5 to 5.25, or 5 to 5.25. It's due, next week. I believe the Fed hikes rates. I think it's next week, to be at 5.5, right? 5.25 to 5.5. And what that means is we're going to be in deep restrictive territory. This is what the Fed wants. So for all of you out there who are like, well, the Feds can't pause, they're going to keep hiking to the moon. Well, we're in restrictive territory, right? And it becomes more and more restrictive, at least on CPI and PPI. And yeah, so I think the Fed's done. I think they are on pause right now. There's a possibility after this report that they do actually pause. That would be hyper bullish for the markets. But maybe that's not the case. Maybe they do hike one more time. Who cares? We're up 500 basis points of hikes. Okay, another 25. Ooh, you think the market really cares? I don't think so. It really cares about earnings, bottoming. So anyways, sticky inflation for those of you out there that say, okay, inflation is so sticky. Well, this is month on month core, right? The core part, services, core CPI. If you annualize, if we annualize it, we're basically at 2%. We're at the Fed's target. Right? Month on month data, which is more coincident, which is sort of looking into the lens, not the macro, not year over year, not looking at the big picture. But if we zoom in, we're at 2%. We're already at the Fed's target, right? Now, can this go up? Yeah, it's kind of volatile, but that was the biggest drop, right? Next chart. That was the lowest core since October of 2021. And really, for some of these graphs, they just they estimate it up or down from 1% to 2%, but we're really at 0.16%. So we're under 2% annualized for core, and which is what all the hype is about for the bears. For the recessionists, core is so low, right? I mean, core is so sticky. It's not sticky, it's evaporating. And you can see on the month-on-month inflation data that it's basically wedging lower, right? We'll be in the negatives pretty soon, right? Maybe not, because I think the economy is stronger than expected. So maybe we don't go negative, but hey, we're at the Fed's target. And the market loves it. Okay, shelter is the primary. So this right here is basically, we got month on month on the left side, and we got year over year inflation on the right side. And this is breaking down inflation into their components. And I have up here, shelter is the primary component, keeping inflation sticky and keeping the Fed from ending the war against inflation. Once shelter drops, once it comes in, which it's really dropping in real time, but once that actually shows up in the numbers, I think the Fed is done. And they can use their expectations and their, Fed talk, Fed speak to actually talk down inflation and say, all right, we can stop QT, right? Even though I think they're already stopped QT because we see other things and we'll get to that. But we can now stop QT and give the market an expectation for QE. Right? We can cut rates. We can start cutting rates, or at least, start pumping liquidity back into the system because supply chains are back online. But anyways, before we run too far ahead, what it means is the big blue, right, month on month, and core, everything is shelter. Everything in red that I have up here highlighted, this is all shelter inflation. Shelter is the biggest component of inflation right now, of the sticky part of inflation. Energy is not there. Hey, if oil breaks out, yeah, we'll go over that. But right now it's shelter. And shelter is due to collapse. If we look at Redfin data, if we look at Zillow rents, if we look at the Case-Shiller home price index, or just home prices in general, inflation, by the way, not the actual price, it's all falling, okay? So inflation is falling while growth is set to rebound. Now, this is where we get bullish. This is where I was wrong. I thought growth would keep decelerating at a faster pace, but it looks like we're starting to bottom in growth. So GDP now, estimates for real GDP growth in the Q2 of 2023 is now at 2.3% as of July, up from 2.1% July 6th. So the GDP now forecast is basically revised up for some reason. I wonder why. Well, payrolls, consumers, and we'll get over that. The economy is just stronger than expected. This is not a full economic report because we go over that every week. So check us out. Check out the newsletter. Sign in. Right, link in the bio or the description if you want to look at the past reports that we've made about GDP. We talk about GDP, why GDP is going over, the economy, the consumer, the housing market's bottoming, the labor market is strong. We all know that, and manufacturing activity might be weak, but we do see service activity picking up, right? So, and we're going to dip into that a little later too as we get through this report. So GDP forecasts are going up. Plus, last week or 2 weeks ago, we had GDP expectations at 1.4%, and they came in at 2%. So something is happening. When estimates start getting beat, you can now forecast. Now, this is not the truth. This is not a fact, but sentiment tells you that things are better than expected, and we could be troughing, we could be bottoming. And if that is the case, the market loves it because the market is forward looking. It looks 12 months ahead, not what we're looking at now, but what could be, right? What could be. You invest because of what could be, right? You do things in your life that bring you value because what it could be, not because what it is. Well, okay, that you can make the case for that. Anyways, that was a terrible analogy. All right, so next part, consumer sentiment is rebounding. So we did get consumer sentiment. People are optimistic, right, in the economy from the survey. If you don't believe the data, great. Okay, you don't believe the data. Wow, right? You only believe it when it fits your narrative. Okay, well, consumer sentiment is rebounding. Savings rate is rising, and we'll get that next reading next month because it is lagging. Incomes are steady because there are jobs. So incomes are still steady because people still have jobs. If you lost your job, we saw a lot of layoffs. There's another job to be filled, right? The service activity, the service PMI in black, right? So I guess I didn't really zoom in on it, but consumer savings is green, and red we got services PMI, which is the services economy, the forward-looking indicators of the service economy. So we can get into that. So it's all about deliveries, employment. This PMIs are purchasing managers' expectations for the next month. How much do we got to purchase? How many people do we have to employ? What is our delivery times? Right. What is the other part of it? What are the new orders we're getting in? So it's basically looking forward at what is going to happen. And we did get that bounce. So services are bouncing, right? But before that, we did get the consumer savings rate bouncing, which preparing for a recession. We got the consumer sentiment bounce earlier in the year in July of 2022, right? Which was pretty much the bottom of the market. It was September, October, and that all bounced, right? And as that coincided, this gray area, what we see here is that's when oil prices pretty much peaked. So gasoline prices pretty much peaked. And then pretty soon we had food inflation peak. So we had food, energy, and producer prices all peak. That's very bullish for the economy. That's very bullish for the market because the cost to live is now no longer, the expectation anyway, is no longer going up. So we saw all those indications start to bounce. Consumer sentiment, the savings rate goes up. And I know a lot of you have heard the whole adage that, oh my God, well, consumer debt is up at all-time highs. Well, it doesn't matter because so are incomes, right? Wages keep going up. So as long as the debt can be serviced, the economy is going to keep chugging forward. There's a reason why debt keeps going up. There's a reason why the stock market goes up no matter what. And debt always goes up because that's the economy we live in. So as long as people have a job, they can service the debt. As long as their incomes are rising, they can service the debt. And that's what we're seeing. Right? The question is at what pace? So number two, the second point here that I got, the cost of global trade just got cheaper, right? The cost of global trade just got cheaper. What does that mean? It means the global economy can now start to rebound. We can start seeing global liquidity start to pick up because the dollar strength is a bearish signal for markets and for other economies for global trade. When the dollar strengthens because everything is priced in dollars, the price of everything else goes down as far as asset prices, and it becomes more expensive to trade globally, right? So in green, you have the dollar. In the blue, well, in blue, I hope you guys can see that. You can probably see it. We have global net liquidity. So this is the Fed's balance sheet, Japan, China, the UK, the European Central Bank, minus the reverse repo, minus the TGA. So that's confusing. Just put it this way, global liquidity from central banks, right? That's what we're looking at here. Now, when the dollar first had peaked, and this is the same time, this coincides with the market peaking. When the dollar peaked, the global net liquidity peaked. So what came first, the chicken or the egg? Do we really know? I don't know, but I'll tell you this. When global liquidity starts to bounce, markets go higher. Markets go higher when global liquidity, everything is correlated to global liquidity, right? The net liquidity of the market moves the market. It's simple. It is very simple. Now, for the macro, it's very simple. In the day, no, it doesn't give you a day trading signal or weekly signal. It is a macro signal. And we see that coincision happening with global liquidity bottoming and the dollar start to peak. Right now, the next highlight that I have here is that global liquidity started to bounce again. And a lot of the bearish people, in crypto, whatever it was, they said, look at global liquidity. It's rolling over, guys. Be scared. Don't worry. And hey, there's reasons to be fearful, but not now. The real fear, we'll get to the real fear. We'll get to where the actual fear is. It is not here. Global liquidity is bouncing because, as a rule of thumb, when economies weaken, when global economies start to weaken, there's only one answer to that, and that is more liquidity. And we see it in China, we see it in Japan, we see it in Brazil, we see it we see somewhat in the UK, we see somewhat in India, right? Because when your economies weaken, how do you think the economies bounces? How do you think economies bounce? Either the government spends or the central bank start buying up the debt to remonetize the debt to get growth going again, or else everything collapses, going to a third world country. So point being here, the dollar is giving us a very strong signal. And I think this is the biggest signal. I'm going to jump over the charts really quick because the US dollar is breaking a huge level. Check this out. The US dollar is finally starting to collapse, right? We've been waiting for this for a while. This is a bear flag technical signal. The collapse in the dollar is my risk on for crypto. It is the primary risk on signal, I think, for markets, other than also obviously policy starting to turn, more dovish or a lot of more supportive, more accommodative. But I think the dollar comes first. And this was our signal to be risk off earlier in the year when the dollar broke. Can't really see this level. When the dollar broke above this cup and handle, this double bottom, that's when everything went risk off. November 21st. First it was crypto, NASDAQ, then the S&P, the dollar went higher. Now we're starting to break lower after the bottoming happened. So the dollar is signaling risk on, right? It is that simple. It is that simple looking at the macro. So if that continuation happens, expect risk on. Now, what does that do? Global liquidity is picking up. Here's the G4 money growth year over year. This is money supply, M2 money supply, right? From the US, from Europe, from Japan, and from China year over year. Now, this indicator is actually lagging, but we did bottom. Whoa, in October, when the market bottomed, that's when global liquidity bottomed year over year, right? From the G4, from the 4 major central banks. And in the gray area, that's basically negative. So we're bouncing at a negative. And what I say is, wow, what a strong cycle, because when you go from the very bottom to the top, you're basically getting net inflow of money supply, inflow of liquidity that fuels markets higher. Is it going to be a bumpy road? Sure, because the recession concerns are still there. Sure, because there's banking risk. Sure, because inflation isn't fully defeated yet. I think the forward-looking indicators tell us it is defeated. It is gone, or it will be gone pretty soon, but there's still risks to the market. Either way, the liquidity cycle is turning up. We're above zero. And, in the current time of July, it is pulling back. But again, central banks, when economies are weak, they continue to print, and China will keep printing because their system is weak. They have zero inflation. They will keep printing, and global liquidity will continue to pick up. Now, talk about liquidity. Let's go over to let's go to the central banks and just look at them. If we separate the two, China still printing. The US, our Fed balance sheet is actually back below the level. And this was, I will admit, this is one of the risk off. This is one of the negative indicators I had. I said, hey, the Fed's balance sheet is higher from here. I was wrong. The Fed balance sheet isn't higher from here. It's actually making new lows, but they already injected the liquidity into the banking system when we saw the collapse from the regional banks. So that's still bullish, right? Now, I expect this to, I do expect the US Fed balance sheet to turn around at some point. And that's probably when inflation does make significant progress. I think it is making progress, but the Fed balance sheet just isn't. Okay, it just isn't yet. But I think down the pipeline, the economy is still slowing and we can monetize the debt. Now, here's the kicker. Maybe it doesn't. Maybe the Fed's balance sheet doesn't go up. Oh, well, Japan is still stimulating and global liquidity is still picking up. On top of that, we haven't even counted, right? We haven't even took into account government spending. So I say, hey, here's the real QE. Forget the Fed's balance sheet. Here's the politicians. We just got Biden administration forgiving $39 billion in student loan debt this past week for over 800,000 borrowers, right? Before that, we had the Biden announced a $42 billion high-speed internet initiative. And preceding that, this is just liquidity we've been looking at from fiscal policy. It's a little different, but it's still government spending. The Inflation Reduction Act here on the right, and then you had the CHIPS Act, which is why NVIDIA is going higher, which is why chips are going higher, and AI in general catches a bid because governments have to support it so they can be on top of the world, so they can dominate, because this is Sparta. And I'm just playing. The point is, governments have to spend for tech to be superior, to keep up with the future expectations of whatever it is, right? You need better technology in your state, in your nation, to sustain growth and to sustain businesses to want to come in. And so you're going to keep getting that. Infrastructure bill, 1.2 trillion. There's not much else to say. Liquidity is still rising in the world. Okay. Number three, the risks are evaporating. These are all the volatility risks, right? That I see, that I'm pointing out, that I have looked at. People are looking at these. I'm not the smartest guy in the room. I'm just pointing it out to my audience here, right? I just want to point this out to the audience. S&P 500, VIX, volatility, moving lower. NASDAQ volatility, moving lower. Bond volatility, moving lower. Credit risk, triple B spreads, moving lower down here in the purple. All right. Now, the first initial spike, what got these things spiking in the first place was when inflation was moving higher and we peaked. Volatility first, had that spike and peaked when inflation peaked. So once inflation sort of peaked, which was the last of June, July, right? July was a confirmation. Volatility came down for S&P, NASDAQ, bond, and triple B spreads, right? What are triple B spreads? Credit risk, equity, credit risk. So it's the bond. It's the debt. It's how much debt is owned for the equity market. So if you're ditching the debt, if you're getting rid of the debt, you fear collapse. You fear you fear stock collapse. You fear equity companies won't be able to repay their debts. So when it comes down, it's really complicated, but when it comes down, it's basically saying, hey, more people are taking risk in the equity market, not the stocks that they're not. This isn't that they're buying stocks. It's that they're buying the debt. They're buying the bonds of equities, right? High yield, whatever it is, because it gives you a fixed income. All right. So inflation peak. Number 2, global liquidity bottomed. That was the second peak. Global liquidity finally bottomed. This was near October, and everything peaked. All the volatilities peaked. The equity credit risk peaked. Okay. Banking crisis, right? This was the last one this is the last spike we saw in volatility for NASDAQ, for bonds, for triple B spreads. It was the banking crisis. The banking crisis spiked, we peaked, and now we're coming back down. So could there be more risks? Sure. Of course they can. Of course they could be. But so far, those risks are evaporating because primarily, like we said, number 1, inflation is coming down. And that's a huge catalyst for the market. And people don't want to believe it. Some people do. Can you be overhyped? Can you buy something overbought? Sure. Yeah, of course. But we're talking about the macro here. We're not talking about your little swing trade, your day trade, or, we're not talking about, oh my God, like you can point out any stock and say this is overbought, of course. But we're talking about the macro, the overall cycle for equities, for crypto, for bonds is starting to turn. The economy is starting to bottom. Okay. Number 4, market breadth. Market breadth is starting to improve. It is starting to improve. Oh, only 7 stocks are moving the market. I don't think so. Over 250 stocks by the end of this last week, July 14th was the Friday. Over 250 stocks up 100% year to date. 259 stocks up 100% in 2023. So we have market breadth. Advanced decline lines, right? The strongest advanced decline lines, which is how many stocks are advancing versus declining. The strongest sector we have is consumer discretionary at all-time highs and industrials at all-time highs, right? Boeing, industrials would be like Boeing, Lockheed Martin, Caterpillar, we know Caterpillar, John Deere. So certain industrials, what is that coming from? Well, probably because the Bidenomics, probably because we're onshoring manufacturing in the US. The housing market is bottoming. We're building new construction builds, non-residential at a very fast pace. And you need industrial technology or industrial weapons. And I'm just kidding. You need industrial tools to build that. So these companies who actually, who actually have those tools are going to get bought up. Now, I'm not going to get into the microeconomics because I'm not an expert there. I'm just looking at the macro, right? But the consumer discretionary, same thing. People are spending, they're going to hotels, they're staying, they're lodging out, they're traveling, right? Industrials also have to do with the airlines, and airlines are booming right now. We know that. Oh my God, here comes inflation. I don't think so. The supply is back online. Productivity is happening. And, we're not getting supply side inflation pretty much anywhere. And if you have questions about that or you want to challenge me, let me know in the comments and we'll go over that. So more market breadth. This is from Bespoke, by the way. 80% of stocks in the S&P 500 are now above their 50-day moving averages. Looking at this breadth reading across sectors, it's cyclicals surging and defensive lagging behind. So now the defensive names, the ones I told you jump into defensive, we're going to a deep recession. Maybe it still happens, but guess what? Right now, that is not playing out. And cyclicals are actually surging, which are the discretionary, which are the, Tesla, Amazon, even though those are more tech stocks. I can't at the top of my head think of other cyclicals. You guys probably know who they are. I just know they're in that. They're probably carrying cyclicals pretty strong. But the point here is, when we look at the graph, the point here is that 80% of stocks in the S&P 500 are above their 50-day moving averages. That is market breadth. Okay, across sectors. Real estate, 100% of stocks. Energy, 100. Industrials, 98. And the worst are staples and utilities, right? Those defensive stocks. The recession stocks are at their worst because the market is not seeing a recession here. It's not pointing out, it is not sniffing a recession. And the market is much smarter than us as much as we think we're smart, right? Now, if something changes, if the trend breaks to the downside, we got to reevaluate, but that is not happening. And we are tracking this week to week, which is why you need to subscribe to the newsletter. It's free. Check it out. Stay informed. Subscribe to the to the channel so you can stay informed, right? We're live streaming Monday through Friday, 10 a.m. Eastern time. Until that changes, I'll let you know. Historically bullish, right? How the S&P 500 fares, and this is the next chart basically. The S&P 5, this is basically 80 to 85% of stocks are above their 50-day moving average. And when that is the case, right? That is the case right now. 80 to 85% of the stocks are above their 50-day moving average. When that is the case, the next week here in light blue, you basically get, well, actually, let's start with the dark blue. When 80 to 85% of stocks are above their 50-day moving average, the next 12 months here in dark blue, the next 12 months, you get a 12.3% return on the S&P 500. Not that you do, that's just been the return about 12.3% over the next 12 months, right? And this is 85% of the time. So this is not a guarantee. This is just a correlation. Correlation is not causation. We know that there are risks in the market, but it's basically just more context, more layers for you to digest and make your trading decisions or make your investment decisions with better information, more context, right? Instead of just that, oh my God, everything's rolling over. So that 85% of the time you get a 12.3% return when stocks are 80 to 85% above their 50-day moving average, and that's where we're at. I don't know when that actually started, but it could have started. This just came out this week, so this could have started last week or 2 weeks ago. Either way, bull market, right? And let's not forget that stocks are still squeezing while earnings are set to bottom, right? I say that, you heard it here. Nobody's going to say, oh, earnings are so negative, bro. We are bottoming, and I'm going to go over that. We're going to talk about why earnings are going to bottom. Okay, I don't know that why I think there's a very fat chance, right? There's a fat probability that earnings do bottom. Now, this chart is basically, we went over this a couple of weeks ago. This was the short squeeze in equities that I call, we talked about maybe a month ago. We said, hey, this was before, this was when we were at 4,200. I said, hey, if we get over 4,200, the S&P is going to squeeze. And it just did that. Now we're at 4,500. Now we just hit 4,500, 300 points in about a month, right? Because the short squeeze is happening. And basically what the short squeeze is, we had a record, right? Like a 20-year, 30-year record. It just kept getting worse of negative positioning in the S&P 500. So I know you guys see all those, oh, everybody's bullish. Yeah, people are bullish, but positioning, S&P 500 net positioning has been very short, very negative. I don't care what people say. Oh, I'm so bullish on the market. Well, what are you actually doing, right? This is what they actually are doing, and they're getting squeezed. We're seeing that squeeze take place. Now, if earnings come out better than feared, as inflation has, the squeeze will continue. I expect that to happen. Number 5, right, or the next point that I have here, earnings may be troughing, bottoming for some of you degenerates. No, I'm just playing. Earnings may be troughing. Okay, so earnings may be bottoming. Negative EPS guidance. These are negative EPSs on the bottom. Negative EPS is basically, I'm sorry, it's at the top. Said that backwards, stupid. For myself here. Let me hit this. Let me hit the button. I gotta roast myself also when I mess up. So you probably heard it on YouTube there. Let me turn this music down. It could be messing up the speech here. Let me see. Let me make sure. No, can you guys? I hope you guys can hear me. I hope I'm not messing up here, because my audio has, I'm not the best at technology here, but I'm trying my best. All right, so I turned that music off because I just want this to be very clear. This is the next catalyst for the market. And when I first started actually streaming on TikTok, I started streaming about earnings because I said, hey, earnings look to be beating expectations, because I am the smartest guy in the room. No, I'm just playing. I'm not the smartest guy in the room. I just like to listen to a lot of commentators and different analysts and bring it all together and make it a little more simple. And I said, wow, when I measure things together, when I measure the two together, it looks like earnings might be coming out better than feared. And we got that in the last quarter. We actually did get better than feared. We actually did get better than feared earnings. Okay. Now, I see you in there, Yassine. I can't find the newsletter on the site. It will be released after this broadcast. I will release the earnings after this broadcast. I'm sorry, I got to touch it up with Grammarly because I can't spell, and I don't want to go through there and read it. And I didn't finish that up. So earnings may be troughing, right? And what we see here is basically this is, we still have to go through earnings, but this is just like, a little insight into the future. And you get companies pre-announcing their guidance. And what we're seeing is that over the years, right, in red, negative EPS guidance has been decreasing through 2022, but now it peaked in Q1. So it looks like we are coming down. Now the trend is not clear yet. We don't have enough data to know the trend, but it looks a little bit like it did back here in 2019, going into 2020, where negative EPS guidance was falling. And when you get, so that's a downswing. And when you get the upswing of positive EPS guidance increasing, that's where you get the market looking forward to say, oh goodness, we've bottomed in earnings. We're going higher. Let's go. Right. And you break out, and we're coming from a bear bottom, and we're going to go a bear bottom. We're coming from a bear market. We broke the bear market trend. We're above all the moving averages. The dollar's breaking down. The Fed is at pause. Inflation's coming down faster than you expected. You got global breath. Things are picking up. AI is a big narrative that nobody understands. It's going to continue to create more productivity at a tenth of a cost. So when you take that in consideration, EPS is much higher. Now I'm going to go through some of the facts. This is from FactSet. I'm going to go through some of the highlights. 41% of S&P 500 companies issuing EPS guidance for Q2 are issuing positive EPS guidance. Q2 has the highest number of S&P 500 companies issuing positive guidance since Q3 of 2021. Information technology, Google, Facebook, Amazon. Probably wrong about Amazon. Information technology and industrial sectors have the highest number of companies issuing positive EPS guidance. I wonder why. AI / their software companies / industrials coming from fiscal policy. We already talked about that. Inflation Reduction Act, CHIPS Act, blah, blah, blah. Software and semiconductors and semiconductor equipment industries have the highest number of companies issuing positive EPS guidance in the information technology sector. Wonder why. Wonder why AMD's up so much. I wonder why Nvidia is breaking all-time highs. I wonder why TSM. I wonder why, well, Micron got banned from China, so it's not really up. But I wonder why these companies are going higher. Right? Semiconductors. So this next picture is a little more bearish. Sorry, you're not going to like this. If you're a bull, if you're a bear, you might like it, which is survival of the fittest. You have to still pick, right, the right companies, because not all will make it, right? Not all will make it. In red, you have more negative EPS guidance, and in blue, you have the positive EPS guidance. And this is broken down by sector, which basically reflects that some sectors like financials, telecom services, utilities have more negative EPS. So I think we know the banking crisis happened, and although the regional banks, and we're going to go over that actually in the next line, the next chart here, we know the regional banks are going to get hurt pretty bad because of the deposit flight from last quarter. That doesn't show up till now. But the market's already priced that in. Trust me. Now the big banks, the too big to fail banks, the too big to fail banks are crushing expectations right now. And, we're going to look at that. But for the most part, right, we're still in a rolling recession where there's pockets of strength and pockets of weakness. And that is showing up in the guidance, in the issued guidance for EPS in this next quarter, right? But for the most part, this is our last, not our last, this was just this past week's banking. JP Morgan, United Health isn't banking, but it is a big company. It's a mega cap. And these are some of the institutional monsters that just reported earnings. And if you didn't hear, you're going to hear it here today. So far, the big banks are beating estimates, and I think they are starting to retain earnings. Top line beats, which mean top line is basically the revenue, right? You got JP Morgan and United Healthcare beating top line revenue, and you got Citigroup beating top line revenue. Okay. But the market cares more about margins or retaining those earnings, right? So how much did it cost you? How much did inflation beat up your company, whatever? And it looks like all of them: JP Morgan, United Healthcare, Wells Fargo, BlackRock, big BlackRock asset manager trying to file for a Bitcoin ETF, will probably get it because they're tied to the government, beating EPS. Citigroup also, and State Street. So they're all beating EPS estimates, right? This is the bottom line, which is, okay, at the top line, you get the revenue. How much does it cost you to run your business? How much earnings did you retain? Are you beating estimations? Are you beating estimates? And we're beating those estimates. So that's, that kind of is just a small signal. Hey, we're doing better than expected. But there's probably some pain to come in those regional banks, right? Now, the key here is, as we come into earnings season, the key here is to understand this, because I get it. We're still in an earnings recession, which means earnings are still negative. But when the estimations are being beat, as in, oh, they're not as bad as we thought, that is a signal that you are starting to bottom, right? I need to come up with a better analogy for this, but I'm trying to get that through your head. right? And the other part is everybody's so negatively positioned, which we haven't even gone over. We went over it in the last stream. We talked about in the last stream, which was that um, equity flows on a year-over-year basis are still negative. Equity flows are still negative. So you're not really getting a whole lot of people participate, maybe retail investors last month, but they're still negative. Also, what was the other part of it? S&P. So it was flows that are negative year over year and margin debt. Margin debt still negative. People are not taking excessive risk in the market. Hedge funds are not doing it yet. There's a lot of cash on the sidelines. And that is fuel for the fire as these expectations come in better than feared. As the macro comes in better than feared, expect that cash to rush in because this might be, you might have your perfect valuation models. It doesn't matter when people have FOMO. It doesn't matter when people chase. It doesn't matter when they need to perform. It doesn't matter when human psychology takes over and emotions. And you might call that a negative effect. It doesn't matter because global liquidity is also set to push higher, right? So that's the macro backdrop there, and tied in with earnings. And I think we're going higher now. Why are so valuations don't matter when everybody's underweight. There's a rush, right? There's a rush to get in. Valuations don't matter when everybody's underweight. Okay. And I just kind of said that, went on a rant. But what I'm saying here is, yeah, you have your valuation. PE is too high. Well, when everybody doesn't own Nvidia, doesn't own Amazon, Tesla, they're underweight. They're going to chase it. They're not going to wait 5 years for it to be 5x the price or 2x the price. They're going to rush in because they know in the back of their heads, AI is the real deal. They know in the back of their heads, robotics is the real deal. They know in the back of their head that blockchain is the real deal / BlackRock. They know in the back of their head that technology outperforms. So they will chase. Now, what are the macro? What are a couple reasons? Inflation is moderating. It's coming down. The economy is stronger than expected. Okay, we've talked about that. And earnings are bottoming. Well, I'm saying that, but I think it's not clear yet, but earnings could be bottoming, right? I'm going to say they are. I think they are bottoming when I look at all my details, global multinationals. I mean, it's a bunch of stuff you don't want to hear unless you subscribe to the macro newsletter. You're going to get that info. And if you join us on the live. So when investors, now here's when valuations really do matter. When investors are overweight stocks, when they're overweight tech companies and the valuations are up too much, then that's when concerns do come into play, because you're like, oh shoot, okay, I do own it. I'm up 30%. Maybe I should shave some off. We're a little overvalued, right? That's when it comes into play. But when you're underweight, when you don't own it, the valuations are not that important when the macro is improving and when you're coming out of a bear market. And everybody knows out of a bear market comes the bull market, the secular bull market. Unless you're one of those guys who thinks we're headed for bear market for 10 years. But whatever you're smoking, let me get some of that. All right. So when this ship turns around, now this is interesting, right? And I have here, when the ship turns around, and I didn't really say nothing. I'm not done with this newsletter, but when this turns around, this is going to be very bullish for risk assets like Bitcoin and Ethereum and Tesla and Palantir, because those are my favorites. Obviously, I'm saying them, but it's going to be very positive for riskier assets for a reason. Cost of capital comes down. I would remember, I'll get to your guys' comments. Okay, I'm going to get to your comments. I'm going to get to your questions. Right, I'm almost done with this. Right, don't rush me. No, I'm just kidding. You can rush me. So basically, we have a record short positioning. Let me just go through the backdrop. We're in a record short positioning for fixed income, and this may be we're actually at the highest negative short positioning on U.S. Treasuries in history. More fund managers, more hedge funds, or whoever they are, investors are short U.S. Treasuries at the highest record we've ever seen, right? Following the biggest, sharpest sell-off in bonds we've ever seen. And when I say short U.S. Treasuries, that means they are selling bonds, right? And it makes sense because the U.S. Treasury is also selling bonds. We see the Fed's balance sheet going down. That means they're selling bonds. They're selling bonds for cash, sucking cash out of the system, which has been the narrative, which is why people are so short the S&P 500, because bond market does signal something for the economy. But I think they're looking at it the wrong way. Uncertainty. Okay, I'm sorry. So why are people now? Here's what I think. I think they're short fixed income because bonds are part of fixed income portfolio. And what I think is that this is actually going to turn around, because people are uncertain about the second half of the year. We all know that. Like I'm still uncertain. When I see the data, it looks like we're not going to have a recession. I think we're already in a recession. It's starting to recover. We're looking at an expansion, a very slow expansion, unless something bad happens. But either way, the second half of the year is still uncertain. So that uncertainty spurs buying of bonds because it is government risk-free debt that pays you interest. So bond buying is happening against these shorts, right? There is buyers in the market. Inflation is moderating, and that's what bonds have been worried about, is inflation too high. And what that really means is, as a technical, if you're looking at literally just the yield versus inflation, the rate of inflation is now below the rate of interest. So you're going to get more interest on, because that's what killed bonds, was basically that inflation was at a higher rate than the bond actually yielded. So why own bonds, sell bonds? It makes no sense to own them, because inflation is eating away all the interest you're collecting. But at this point now, things have switched, right? The things have actually changed, where the rate of inflation is now at 3% headline. And you say, oh, well, it's core inflation, but core inflation, bro. Energy, food matters. Okay. I'm sorry. It does matter. So people don't walk around without food and without energy. That does matter. Headline is at 3% year over year. Okay. You want to annualize the month over month? We're at 2%. So the rate of inflation is below the rate of interest. So the bonds right now, and we'll get into bonds. Bonds are yielding what? 3.7%. And so that's a positive. That's a reason for demand to come into the market. So there is a demand for fixed income because people are uncertain about the second half of the year, right? Now, this one just came out this week. This is basically highlighting the ETFs with the biggest inflows, right? S&P 500, QQQ, technology, of course. But I have here highlighted the US Treasury Bond ETF TLT, right? Now, this is 20-year yields. Well, to make it simple, these are bonds. These are US bonds. This is probably the biggest ETF. They have the biggest inflows. So people, this is 1 week inflows. There is demand for US treasuries. And what that does is it pressures the shorts to cover. And I think they've peaked. I think the shorts will cover because inflation is abating and the economy is recovering. Actually, the economy recovering really doesn't help bonds. But for the most part, the yield is better than inflation. So that's going to spur more bond buying and uncertainty buy bonds, right? And eventually, when the Fed pivots, what do you think they're going to do? They're going to buy bonds. So the bond market, the bond trade is on, even though everybody's been wrong for the last 12 months, including myself, right? I've been wrong about bonds. I thought they'd go higher sooner. Either way, it's inevitable. It's coming, right? The bonds will get bought up. Global equities too. So what turns this boat around? Now, just to visualize it, this is the chart. These are bonds at the bottom. Bonds sold off at the biggest rate in history, right? Bonds, TLT, whatever. We're consolidating at the lows. We're forming a base. It looked like we're going to break down, and we finally bounced. And what you must understand here is that inversely to bonds is actually rates. So real rates, not the Fed funds rate, but real rates. The real cost of capital is the bond market. That's why it's so important to the equity market and to risk assets, because real rates come from the bond market. Now, as a benchmark, I'm using the 10-year treasury yield, and what you must clue into, I don't know how I can say this any clearer, is that they move inversely. As bonds go up, rates come down. As bonds go down, rates go up. So what have we've seen bonds come down and rates go up. I'm saying rates may be peaking because bonds may be bottoming, because the inflows that we're starting to see come into the market. Now, what causes this to fully turn where bonds bid up? Slowing inflation and the Fed pivot. We are getting slowing inflation, right? Inflation's coming down, but the Fed hasn't pivoted yet. As a matter of fact, they're going to hike again 25 basis points. So we're not there yet. But the anticipation is around the corner, right? The anticipation is around the corner. So here's the actual chart of record short US treasuries. And this is all to say that people are betting on higher yields, but with inflation abating and the Fed near pivot, if the Fed pivots, this thing squeezes up, right? Yields come back down. Risk assets catch a bid even further on top of the macro backdrop because the cost of capital is cheaper, and riskier assets like Bitcoin, crypto, Tesla, technology in general, their earnings come later, right? Not crypto in general, but the earnings are expected to be into the future. So that's why yields, 10-year long duration yields, or long-term rates are so important. The lower they are, the cheaper the higher the earnings are going to be in the future. It's really look at the bond market's confusing. That's why I'm on here to make it simple. Let's just put it this way. If this squeezes higher, risk assets go higher, bro. Risk assets go higher, period. Right? Now, here's my biggest concern right now, and it is looking like it's trying to play out, which is the cost of crude oil, because oil is the biggest input to inflation. And, oil, if it breaks out of this downtrend that we've been in for the longest time since we peaked last year, then that does make inflation a little stickier. And if it gets really wild and gets above 84.50, then we're in trouble. I think equities do have a significant correction, maybe back to 4,200, maybe even back to 4,000. That's the risk. That's my big risk off, right? But for that to happen, you're going to see the dollar start to spike back up, and you're going to see yields start to go much higher from here. So there's other gauges that tell us whether this is a real risk or not. I think it's the biggest risk, but it may not be a risk. We may just consolidate at these levels. If it drops out, the pendulum swings in the other way, where energy becomes cheaper. And if energy becomes cheaper, well, I mean, that's very bullish for growth and productivity and the stock market and crypto and all that. So that's my big concern there, is oil going higher, right? Upgrade your subscription if you want to support me, if you think I'm worth it. If not, leave the stream. No, I'm just kidding. So, yeah, that's the macro report. Let me go through the questions now, right? I'm gonna go through the questions. This is not the headline for the YouTube video, but end game for bears, end game signal, wave 2 FOMO. And I think we're there. Also, the market is starting to break out. But anyways, we'll do technicals too if you guys want to go over that. Let's get to these comments, to these questions. All right, first we got or actually, let me shout out the chat, man. Shout out to you guys for showing up, man. To a guy like me who wants to listen to me run my mouth. Shout out to you guys. You guys actually showed up. All right. Appreciate you guys' support as always, my friend. Keep asking hard questions. Never trust anybody, including myself. Do the work for yourself. But I will send this newsletter out in a second. All right. So question number 1. What about consumer spending? Consumer spending is Bukowski. Consumer spending is decelerating. So let me run over to consumer spending. Consumer savings is going up, and consumer savings are consumer spending is falling currently, right? And I let me see, duplicate tab, because what I want to do is I want to go to the home page, and so you guys can see this. If you guys want to rub up on the or check out the, come on, man, come on, load up. Oh, there we go. If you guys want to check out I talked about consumer spending on the last newsletter. Okay. So let me just pull that up really quick. Oh, grow your glutes. We're going to have a fitness TikTok pretty soon here too, in about 3.5 hours at 7 p.m. Eastern. Anyway, so last macro report, let's go over consumer spending. Where is it? I know I went over consumer spending. We talked about it. No way. Where is it? Is this it? Oh, here it is. Yeah, I knew I did. All right. So consumer spending is right here. So we see consumer spending is coming down. Now, this is negative if you think consumers spending will collapse to the zeros, right? To the zeros. But what we do see is that consumers are just spending more in the goods, in the services sector than the goods sector. Retail sales are falling, right? So if we do go negative, that is a risk. But again, we're getting a lot of fiscal policy. As long as people, I would say this, Bukowski, as long as people have jobs, spending will continue. They will keep spending. They're not going to keep spending because, hey, we're Americans, we're consumers, right? If it goes negative, then if we do go negative, we're still positive. If we do go negative, we have a problem. We do have a problem. But that's not the case right now. We're not going negative. So that's my response to consumer spending. We're still, and I'm going over the YouTube chats first, because that's primarily where I'm at. So consumer spending is coming down, but it's not negative. And the services PMI show you, the airlines show you that people are still spending. All right. So anyways, been waiting for this moment. What up, Slime Z? Shout out to you. Been there since day one. Manny, what up? What up? Hope everything's going well. The small bump was from the bank injection. Yes, Bukowski, the bank injections was that small bump. It's coming back down. So we'll see what happens. It's not like the most bullish signal, but when you look at the overall context, all other central banks are printing, and the TGA refill was it wasn't nothing. The TGA refill that sucked liquidity from the banking system just didn't happen. And I actually talked about that in a previous macro report, which was the fact that the TGA refill was a non-event. And as a matter of fact, that just came from the money market funds. The money market funds are, this is the site. I'm just going to market my site right now, or our site, so you guys can check it out there. We got some stuff on there. But the liquidity that was supposed to drain from the banking sector to go in to fill the US Treasury account so they can keep spending just came from money market funds, right? Which were really parked at the Fed, So really, the money's coming from the Fed, the reverse repo. At the end of the day, right? As complicated as the Fed is, they do one thing: they print money and they fuel growth. They buy it, they fuel growth, and they print money. That's literally how the system works. At the end of the day, you just want to know when, what, how long, and where are we in the cycle, right? That's the most important. Where are we in the cycle? All right, so we got Dimaj. What up, Dimaj? Nvidia has a monster gap to fill to break out. Does it? Nvidia has a monster gap to fill. Nvidia. Let's go to Nvidia really quick. Let me see. Nvidia. Where's my Nvidia at? Gap to fill on Nvidia. Does it have a gap to fill on the upside or the downside? Oh, this is the weekly chart. Let's go to the daily chart. It does have that gap down there, Dimaj. Maybe I'm missing something, but Nvidia monster gap to fill to break out. If it does ever, I don't think it's going to fill this gap. I think Nvidia is off to the races. I think it's off to the races. It's by far the best chip stock, in the market. That might change when Tesla comes out with their supercomputer Dojo bullishness, but for the most part, yeah, that's where we're at right now. All right, we got the underground economist. What up, underground economist? Been waiting for you to come on the stream so you could tell us about Bitcoin and Tesla, because you are a maxi. You have a lot of research. This guy is really well informed. So we got to have him on. He just needs to get a mic, and he needs to stop being a wuss and let me know so we can talk, because he's a smart guy. All right, AI will turbocharge the economy, AK tech and crypto will benefit from it, but BTC is the simple way to earn your slice of the growth pie. Fair enough. I agree 100%. All right. Paul Alger, margin debt is low because interest rates are high. That does make sense, Paul. 100%. That does make sense. Interest rates are still high. So once the Fed cuts rates, we'll probably see margin debt go up. Either way, I think margin debt, it still signals like the overall thing is that people are still not levered in. They're not levered in, right? They're not levered up yet. So once that does get cut, here comes the margin debt, right? Would earnings bottom going forward? Globally, it isn't going well, and hikes aren't in full effects yet. Not even done hiking. Really good question there. Would earnings bottom going forward? So we do have now. Look, I'm gonna keep you guys updated on the earnings picture. Right now, what we're seeing is a shift. Earnings are still negative, but I see a shift happening before a couple of reasons. Let me turn to my board because I can't memorize all this, but this is why I think earnings are starting to shift and why we beat earnings expectations in the last Q1 earnings. Why do we beat? Okay, primarily. Number one, keep this in mind, fiscal policy. Okay, fiscal policy, Joe Biden, Inflation Reduction Act, CHIPS Act. Right now, these new things that he has on here, which I literally just showed up here. The more government stimulus, the more you're going to pump some part of earnings to some degree. It might not go into the company or the stock you're holding, but it will pump earnings because you're putting spending into the economy. Okay. Number two, cost cutting. A lot of big tech companies, a lot of companies cut costs by getting rid of employees, right? So when you do that, and if you could still operate with software, software as a service, if you can still operate with less employees, well, you just cut margins, right? All those payrolls now goes to your earnings and goes to your bottom line. Next thing you know, earnings are pumped. It doesn't mean your earnings go up. It just means you retain more earnings because you cut workers. And so cost cutting, and they did some other cost cutting too. Meta did the same thing. They cut a lot of projects that were just like, all right, let's forget this. Let's just cut costs and be efficient, right? That was another reason. Number two, multinationals, margins improve, revenue improve. So as the dollar falls, this one's really technical, but as the dollar falls, and it's been falling since October of 2022, let's go to the dollar here. I guess you see the chart. As the dollar falls, the cost of global trade goes down, and people in other countries, I actually have a post about this, people who live in other countries, there's an effect where the currency of the dollar goes down, their currency goes up in value. Therefore, they have more income or more buying power. Therefore, demand goes higher. And you can argue the micros, but therefore the demand goes higher because they have more money. If you got a paycheck bump, let's do simple psychology. If you got a paycheck bump, oh, we're gonna increase your your monthly paycheck by 20%. What are you gonna do? Save more or spend more? Hopefully you save more too, but you're going to spend more, right? So when the dollar drops, multinational companies benefit, their revenue goes up, their margins increase, and also not only just the dollar dropping, China and Japan get fueled by a dollar drop. Their economies go higher, their currency strengthens, and they're printing money right now. So their citizens are going to buy more Tesla cars, which is why Tesla was the number one selling car in the world this past year, the Model Y, by the way. Okay. So multinationals and China and fiscal policy. So those are the reasons why earnings were better. Now, this coming up season, I think, or this earnings season, Bukowski, to answer your question fully, globally, it isn't going so well. Well, yes, you're right. But like I said, global liquidity picking up, right? So as we see, where is it? Global liquidity. This is why I think earnings are bottoming, because liquidity is not slowing down. Liquidity has to move up. As a rule of thumb, maybe I'm wrong here. Maybe you could bash me, but as economies slow, the only answer is more cowbell, as Raoul Paul says. The only answer is more stimulus, whether it's from central banks or fiscal policy, and that's exactly what we're starting to see. So yes, the rate hikes are not fully, they are a lagged effect, but you also have to factor this in, right? Check this out. Nobody talks about this. Yes, the rate hikes are in, but do you realize that all the dividend income people are spending, right? The rate hikes also enable money market funds to pay you on your cash, that extra cash that people are getting yield from as the rate. So as rate hikes are elevated, they also produce cash at the money market funds. So they're giving you a percentage of cash. That cash is going to investors. They're spending that money. So net more liquidity with rate hikes up, it still creates more liquidity ultimately from the Federal Reserve, because they're paying money market funds interest, right, from the Fed. And that interest is going to consumers or people who are parking their cash. So still more liquidity. So yes, the hikes are not fully in effect, which is why we will still get more banking turbulence and commercial real estate turbulence. But is it big enough to knock off the big banks, the too big to fail banks? I don't think so. Is it big enough to knock out residential real estate? I don't think so. Commercial real estate is on a lot of regional banks' balance sheets, so they're going to have some turbulence. And if they do fail, which is why we look at KRE, what does KRE look like? If KRE rolls over, well, what happened last time? More liquidity, right? And that's why I have that highlighted there, because when KRE is starting to rebound, this is a proxy for regional banks. If it rolls over, look out for more bank term funding program. Look for the Fed to pump in that that Fed balance sheet to go up again, right? That's it. I mean, that's it. Now, do I know this for a fact? No, I don't. But nobody does, right? This is just looking at history and correlation. This is where I take my bets. I'm betting on the Fed to do exactly what they did last time. So the more hikes are not in full effect, I agree, but they can always do this. When inflation's high, there's an issue. You can't really slow down inflation. You have to destroy demand, right? Demand destruction. But when growth slows, when demand is down, the Fed can turn that boat around very quickly by doing what? Cutting rates. If things fail, they can cut rates. If things fail, they can pump liquidity. If things fail, they can increase the balance sheet. So I'm not worried about that, because historically, 2018, at the end of December, what do? They cut rates, growth slow, they cut rates, they started the balance sheet up again, growth recovered, stocks went higher. So the real issue is always inflation, and that is making progress. And that's why I'm bullish, right? Economy recovering doesn't help bonds. Yeah, you're right. Exactly, Paul Auger. That's why I said the economy recovery doesn't necessarily help bonds. I think the catalyst for bonds is people are uncertain, so they're still going to buy them. And then number two, because think about it, sophisticated investors might sell bonds, but most people, like, family offices or whatever, they're going to want to own some bonds because it's risk-free interest. Also, now the interest is paying you more. And this wasn't historically the answer. You guys got to please dial in on this. For the last 10 years, bond yields paid you nothing, right? Interest rates were virtually zero, right? Maybe I'm wrong about this, but let me actually go to the yield. Let's go to the yield, the 10-year yield, right? All right. So in the past, the reason why bonds really didn't get bid up, what were bonds yielding? 3.4%. They weren't yielding much. So what I'm seeing here is, as inflation trickles, we're at 3%. So bonds are at 3.8%. Inflation's at 3%. So about right here. As inflation continues to come down, maybe it gets sticky around here, you're still getting a spread on those bonds, right? You're still getting a yield. And as the yield overcomes the inflation, the interest rate, or the cut on your capital, the cut on your cost on inflation, then that causes that's going to psychologically say to people, oh, I'm actually yielding more on I'm yielding versus inflation, right? I'm getting more on my bond versus inflation. Plus, on the upside, what else you got on the upside? You also have the appreciation of the bond at all-time highs, right? So bonds are at all-time lows, biggest sell-off in history. Well, you still have it now. Does it go to all-time highs? I don't know. But either way, you have appreciation on the underlying bond. So bonds are attractive. I don't think they're more attractive than crypto or than stocks, but they're still attractive for a portfolio 10, 20% because they hedge against risk. They pay you monthly, yearly, whatever interest rate, and they have the chance to go higher. And when the Fed cuts rates, they're going higher. And when yield curve control starts back up, they're going higher. So they're attractive, right? It's a risk-free trade or investment, unless there's a black swan and inflation comes back up. So yeah, and the biggest risk right now, I think, is it's not really that big of a risk, is the UPS strike. That the UPS basically, that's a big supply. That's probably one of the biggest logistics supply chains. If they shut down, which I don't think there's going to be a lot of fear. UPS is going to shut down, and we're going to zero. They're going to make a deal. They're going to make a deal. Nobody's going to risk that. But that is fear because it's uncertain, the market will price that in. So I think we're going to get some turbulence going into the end of July, as we get closer to the UPS drama. Okay. Where do you get the numbers for inflows into ETFs? I got my numbers from, so I'm going to just point you to this guy. His name is Jurrien Timmer, right? Jurrien Timmer. I could probably find them myself. There he is. I could probably find them myself, but man, that's a lot of research. So why look for it myself when I could just literally find this guy. He is a Fidelity macro researcher, and he always has a lot of charts. Sometimes I don't even understand his charts. This dude's so complicated. But Jurrien Timmer, go through his Twitter feed, Timmer Fidelity, and you'll find his stuff. Or you go to my newsletter. But where to find them? Good question. Bond inflows. I probably have a way to look at the ETF inflow somewhere, but I just haven't got to it. Maybe I'll put that on my macro. But when I get the signal, I'm just going to shout it out there. Oh, look at this. 10 largest stocks. The stock market remains in a trading range that is now a year old. The 10 largest stocks are closing in on the old highs. Okay, great. So he has a lot of good stuff, man. I'll point you to anybody. I don't know everything. I just like to take a circle of the smartest guys, or the people who are in my favor that are using my bias, because I want to be right. No, I'm just kidding. I'll take the guys that I think are the smartest, and I'll definitely put some of the research together and try to quantify it, try to simplify it. Also the Bears too. I listen to Morgan Stanley. And what's his name? Morgan Stanley. He was actually on my thumbnail. His name is Mike Wilson, and he's basically just bearish on earnings. I think he's wrong. His thesis is kind of simple. It's just he's bearish on earnings. He thinks they go super, super negative, but not with all this fiscal policy. I don't think so. Too much fiscal policy and other stuff going on. All right, it does help bonds. Okay, let's see. Especially the lower rated bonds. Yeah, the lower rated bonds are yielding a lot of interest right now. I think like 4.5%, 4.4%, way higher than inflation, which brings down, actually helps the yield curve, because more demand that comes into the bottom of the yield curve, right? The short duration bonds, then the yield curve starts to steepen, or it goes back to where it should be. And you get shorter, you get better lending, or you get cheaper lending or cheaper borrowing to fund short-term growth. And that's a whole lot of word salad, but what it basically means is selling short-term duration bonds at such a good value is going to help the economy and the overall lending bond market in general over time. I just don't want to go. I don't want to get. I know I'm going to lose people, so I'm not going to go over that. Corporate emerging bond market, corporate emerging market bonds. Oh yeah, that actually does remind me. If we look at the junk bond market, it's also bottoming, right? I didn't put that up there, but along with the volatility, but the junk bonds, this is J&K, this is high yield bonds. They've been up since October 2022. They're not shooting straight up, but that tells you that people, and this is about to break out, by the way. This tells you that there's risk being taken in the corporate bond market, right? Investors, whoever they are buying corporate debt because they believe that we're going higher. If they didn't believe that, this thing would be selling off. Do you think Meta will fill the gap at 317, or are we going to see a pullback to 300. Meta is struggling to fill the gap all week. Let's see what Meta looks like, and then I'll get to the TikTok comments. Meta to fill the gap at 313, you said? Man, Meta's been on fire. It's been on fire. So let's see. The 317 gap. That must be up ahead, huh? The 317 gap must be way up ahead. Let's see. But yeah, Dimaj, do you think the Meta three are we gonna see a pullback to 300? Okay. Basically, it just sounds like a basic technical. I really don't know. Like, I would even count a very big pullback on Meta just because yeah, Meta's so strong and the overall market is breaking out. Like, just in general, we got the S&P and the Qs headed for all-time highs. I think they're going all-time highs this year based off the macro backdrop. So I don't know, man. Meta could come back to 300, right? It could come back to 300 to support that. I don't know what would cause it to come down. I think it can. It could probably come back to 300 for sure. I'd be patient. I say this. If it's overextended, just wait for the opportunity to come back, find support, and find risk there. If it keeps going up, just let it go up. Don't chase it. Don't chase it. Even though it could go up a lot, don't chase it. There's a lot of restriction, a lot of restriction slash resistance at these levels. Let me pull this mic back. Hopefully it's not too bad. It could take years to fill a gap. So yeah, Meta looks good. I would look for a big pullback or long consolidation in Meta. Because it's very overextended and it could just keep doing it. But just, you don't want to be that guy, right? Gets in, you're like, okay, let's go. Let's finally go. And then boom, it rips back on you. You're down 30%, pissed off or whatever. So wait for some more consolidation and earnings too. Earnings could have it, earnings could cause Meta to rip back, but there's other opportunities in the market. All right, so let me jump on some of these TikToks. Simple, you do your homework. Thank you, appreciate it. C-Town Rock 100, that SHIT won't stick. Let me know what you're talking about. Inflation definitely coming down. People can't afford SHIT. Yeah, they can't. Off topic, should I keep my 50 shares? This is Amandi. Should I keep my 50 shares of NIO bought at 7 to 9 per share? I don't know. If you want to book a call with me, you can. Link in the bio. You can book a call with me to go over like more personal stuff. And I'll just tell you what I would do. I'm not a financial advisor, but I could tell you what I would do, how I would look at it technically, the fundamentals. So book a call if you want. Anybody could book a call too if you want to get more, personalized. I don't want to call it suggestions because obviously you can't do that. But if you want to hear what I would do or how I would look at it, and everybody's situation is a little different, then go ahead and book a call there on the website. Link in the bio. If it's to be studied, how can only I decide? Yeah. What up, Dimaj? Head into earning seasons. Study chart, read news based on that, come up with a play. Anything could happen in the market, but I get it. It's tough. There's a lot of stuff going on. And if you're new or you're not used to it, then you kind of want to get somebody else's take. So I could give you a take, but there's more questions I'd want to, answer or look at. Me personally, I like Tesla as the best play. It is overextended, but we are in a hyper, there's a lot of catalysts that suggest Tesla will go a lot higher. Now, crypto, I would rather be in Bitcoin than NIO any day, personally. Play the market, don't let it play you. Hey, it sounds good, but beginners, bro, like beginners don't understand that. You can't just tell somebody, hey, read the news. Like, it's too much information. It is a lot. It is information overload. It's very confusing. People don't know where to start. You got technicals, fundamentals, macroeconomics. It's hard. It is tough. So I get reaching out, asking for help. I wish I had somebody to reach out to ask. I wish I could trust somebody. I'm not going to tell you, you got to trust me. You don't have to trust me at all, but I'm going to give you enough information where you could go make your own decisions, right? And you can think about it. And I know my biases. I am pro crypto. I'm hyper crypto. I'm a bull right now. I'm not bearish until things show me otherwise. I look at the technicals and I like tech, but hey, if you want to buy bonds, I think it's, there's different takes on it. So everybody's a little different. Kind of difficult finding everything out yourself. It's tough to find stuff out yourself for sure. Stocks or options. Stocks are simple. Options are very complicated. If you're new, I wouldn't even think about it. I can't find the newsletter. Yes, this newsletter will be released after this. I had some weird, crazy nightmares. I thought, what the heck is this, bro? Don't tell me this is we got some bots in here. Got some weird nightmares, bro. Talking about dreaming. I don't know what this sounds like. A bot. Unless Santa Cruz medicinals, go check. That sounds like content for our fitness channel, which we are going to be live on TikTok in about 2 hours from now. We'll be live on there in 2 hours. And if you want to talk about sleep or whatever, go check us out on there. Santa Cruz medicinals. All right. Any other questions? Q&A. I got to hit the gym. Right. Got to get those lifts in today. I got well, I'm not going to talk about my workout, but I got to hit the gym in a second. So let me know your guys' questions. We went over the macro report. Subscribe if you haven't already subscribed. We will be live Monday through Friday, right? 10 a.m. Eastern time. You can check back on the stream if you want to see what we talked about that day. And check us out. Beginners that are new trading, I would say learn as much as you can. To be real, for when it comes to trading, it takes like 3 years to know what you're doing for trading. Some people are quicker, some people are not as quick, but you want to invest in your education first and foremost. There's a book by Mike Balfour called One Good Trade. There's another book called The Playbook. I actually think I have them on my website. Go learn as much as you can. I have a lot of free content for trading, investing, all that on the site, right? Link in the bio. Just check out all the content. You click on it. If you're on YouTube, you can actually see it here. You have trading, self-improvement, investing, health, economics, crypto, and just learning in general. So just invest in your education first. Don't go taking trades or put risk on. Invest in your education first. Formulate a plan, an understanding, a framework of the market, formulate a framework of how you might want to trade before you do anything. So educate yourself first and foremost. That's my advice, man. All right. Well, if that's it, if that's all we got today, let me close it out here. Let me close it out by saying this. And I think this is going to be the theme, right? This is going to be the theme here. Where is it at? Valuations don't matter when everybody's underweight. There's a rush to get in because inflation is falling. The economy is stronger than expected. And if earnings are bottoming this season, you're going to see really strong FOMO coming into the market. That's all I got for you guys. You guys stay blessed, eat healthy, get your sleep, improve every day. Do what you can. We'll be live on TikTok in 2 hours for the fitness show. Get my exit music. It sounds cool. All right, cool. We got the exit music here. Oh yeah, that's what I was going to tell you guys. I'm still trying to do the debate with the bearish guy. Still trying to set that up. We almost had it for tomorrow, but we had to redo it because something changed in the schedule, but it should be good. And I'm looking forward to that. We'll be live on either TikTok or YouTube. I'm not sure. Other than that, okay. Yeah. You guys stay blessed, man. I'll catch you later. Thanks.